Hello, my friends. Today is April 22nd. My name is Joseph, and this is Markets Weekly. So, this week we're going to talk about three things. The first thing we'll talk about is that the regional banks seem to be sounding the all clear. I listened to a number of regional bank earnings reports, and you know, by and large, they were saying the same thing. Things are okay, and there doesn't seem to have been a big fallout from the panic in March. The second thing we'll talk about is the prospect of sustained stagflation. Stagflation is when we have low or no economic growth, but inflation remains high. It's what happened in the 1970s and 80s. And we have some indicators and some commentary that suggests that people are becoming aware that this is a very likely scenario. And the last thing we'll talk about is what's happening with the debt ceiling. And one measure we can try to tease out as to how concerned the market is about the debt ceiling. Okay, let's start with the regional banks. So over the past few days, we had the earnings reports of a number of major regional banks. And they were all basically singing the same tune. First, in all their earnings reports, they strongly differentiated themselves from Silicon Valley Bank in a couple ways. All the regional bank earnings presentations made a special effort to show how their deposit base is very much unlike the deposit base of Silicon Valley Bank. If you're a bank, what you're afraid of the most is everyone going and asking for their money back at the same time. In order to avoid that, a prudently managed bank has a lot of tools at its disposal. One thing it can do is it can diversify its depositor base. Make sure that it's not all one industry, so that in case that industry does poorly, like tech, all the depositors won't actually have fewer deposits at the same time. And another thing banks often do is to make sure that their deposit base is diversified between insured and uninsured. If a bank is in trouble, the insured depositors, historically speaking, don't really care because they know either way they're protected. So a prudently managed bank makes sure that they have a large deposit base that is insured, and part of it, the part that's not insured, the uninsured deposits, they make sure that they're sticky in a different way. For example, it's very common for a bank to cultivate long-standing relationships with their corporate clients, or to make sure their corporate clients depend upon them for other things, like payroll, for example. Imagine you're a big corporation and you pay thousands of employees through direct deposit. That's a payment processing service that the bank provides, and even though perhaps you put money in a bank and it's not fully insured, because the bank provides those services for you, you're less likely to run away, because obviously it's really hard to find a replacement for that. Now, the regional banks that I've seen basically all emphasized strongly that their deposit base has lots of insured deposits, and among the deposits that are uninsured, they're usually deposits from corporations with long-standing relationships or treasury functions, so the payment stuff that I was talking about. And that is actually true. The regional banks, any actually well-run bank behaves that way. It was really Silicon Valley Bank and perhaps Signature Bank that was an outlier in that sense. One of the commentaries that I thought was particularly striking was commentary from PNC Bank, which has about $500 billion. And PNC Bank, in their earnings call, straight away, the presenter, I believe it was the CFO or the CAO, basically said that, yeah, we had all this excitement in March, but we kind of looked at our own books and we really didn't see anything out of the ordinary. We didn't really notice it. And I think that was both striking and in line with my expectations. If you remember, over the past few weeks, I have been repeatedly noting that whatever happened with the regional banks was very localized and likely not systemic, and that is coming to pass. Regional banks are largely, as the name suggests, regional. So what happens in California doesn't actually necessarily or impact what happens in Ohio or in Texas and so forth. And regional banks, because they're not systemically integrated and more local, they are more insulated. But anyway, so PNC came out and they told everyone that, everything's fine. In fact, it looks like their guidance for the full year, actually not this slide, yes, for the full year here, is for loans average loans from 2022 to 2023 to be up 5 to 7%. Now, everyone was worrying that the regional banks would pull back, there'd be a credit crunch, and then we'd have a recession or something like that. And here is PNC telling you that no, I don't really think that's going to happen. Don't really think it's a big deal. I expect loans to be up 5 to 7% this year. And they're not the only one who said that. Here's another one. This is KeyBank, a bit smaller than Silicon Valley Bank, a little bit under $200 billion in assets. And they're saying that they expect loans to be up 6 to 9% as well. Now, across the regional banks that I looked at, there was a number of them. Some of them said they expect something of flattish loan growth. U.S. Bank was like that. But generally, they expect some growth. And they noted that growth would not be as strong as it would be last year. If you guys are familiar with my work, then you know that last year was truly a year of epic bank credit creation. Historically speaking, banks make about $400 billion in loans a year. Last year, we made, I think, about $1.2 trillion. So last year was a bonkers year for credit creation. That year would not be repeated. The regional banks that I looked at largely remarked that they expect that, yes, they will tighten credit standards a little bit, so that's going to decrease the supply of loans. And they also noted that there's a little bit less demand as well. Obviously, interest rates are much higher. But all in all, it's not a credit crunch at all. It is a gradual slowing of the economy as from very elevated levels and as the economy gradually cools. So the impact of what happened in March looks to be very brief. Just as another point, looking at the macro data, so we had the weekly data from the Fed showing the growth rate of loans and leases. Now, 3 weeks into April, we have the March numbers that are seasonally adjusted at their annual rates. And you can see here in March, according to the aggregate data from the Fed, loans and leases grew at a seasonally adjusted annual rate of 6.2%. And you really can't see any contraction at all. And we have the data, weekly data for 2 weeks in April, and you also see steady growth as well. And now, just to top this all off, I thought I'd share this with you as well. So this is the GDP Now statistics from the Atlanta Fed. What the Atlanta Fed does is it collects data as it comes in, and it gives a real-time forecast of what it thinks the GDP would be. And as of last week, it's thinking 2.5%. Now, 2.5% is actually above trend growth. The underlying potential for the economy is estimated by the Fed to be about 1.8% a year. So 2.5% is growing above the potential of the economy. And if you add inflation to that, let's say 6%, the nominal GDP is growing at 8.5% a year. So you really, the totality of the data suggests that the economy, along with the the strong employment data, low unemployment claims, and persistently high wage growth suggests that things are fine. So see a lot of doom and gloom out there, but I'm not sure it's justified by the numbers. And if you remember from our discussion last week, the biggest thing in the market is that that's been driving all market prices is that the market has been aggressively pricing in Fed cuts later in the year, and that has led to equities going higher, dollars selling off, rates lower. And now the market is slowly beginning to realize that that scenario is just not realistic. And so this past week, we actually saw the market take out some of the rate cuts that were priced in. And in line with that, we saw equities decline a bit, we saw rates go up a bit, and we saw the dollar strengthen a bit. My expectation is still that eventually the market would take out all the rate cuts that are currently priced in. Okay, now that we are finished discussing that, let's talk a little bit about the prospect of stagflation. Oh, okay, one more thing. This is just in line with these strong GDP data. This is Bank of America showing that their payments data, so let's say buying stuff through your credit or debit card, and the Bank of America, big bank, lots of data, lots of people use them, so they have a really good sense of what's happening in the economy. And they're saying that, the economy, from a spending perspective, consumer spending is fine. Year on year, there's a 9% growth, and more real-time spend data looks like it's fine as well. It's holding up. There's really nothing that's really obviously wrong about it. Okay, now back to the topic of our second topic, the prospect of stagflation. So, Christine Lagarde, who is president of the ECB, gave a very interesting speech the past week. And in that speech, she was basically highlighting something that many people have been observing, people like Peter Zion, for example, that we seem to be having the reversal of globalization, and that has really big impacts for both inflation and for global currencies. So, in her speech, which is very accessible and I recommend everyone take a look, is that she's saying that, over the past few decades, we had a period of, pretty low and stable inflation, in large part because the supply side of the economy was doing really well. We had globalization, so people from uh, the Chinese were able to send stuff to the U.S. Hundreds of millions of Chinese laborers basically entered the global labor force, and in the same way, we could import stuff from all over the world. That was a world of globalization, and when you increase the supply of goods and services into the economy, then prices decline, and its inflation is much easier to control. And in addition to that, we lived in a world where the US dollar was the indisputed champion of currencies. So everyone used the US dollar to invoice goods and services. So that means that if you're a Japanese company buying from say Indian company, you would often pay in dollars. And because everyone dealt in dollars internationally, there wasn't as much of a currency impact when you talked about pricing. Now, Lagarde is saying that it looks like the world is breaking into two. We're breaking into maybe a block that's, say, Russia and China and North Korea, Iran, and people who are closer to them. And we're breaking into another block that is the West. And when you do that, there's not going to be as much globalization. And so all the stability, all the low prices that we enjoyed in the past might not be the same for the coming years. There's a prospect of, as we've already experienced, more volatile supply chains, which in turn leads to volatile inflation, which in turn suggests that we could have higher prices and lower growth in the future, since we don't have the supply of goods and services is not flowing globally as well as it used to. She also made an interesting point that now that people want to move away from the dollar, well, maybe the dollar is not going to be the international currency of trade anymore. And if that's the case, if in the future, say, a Japanese company buying from an Indian company, well, the Indian company wants to pay in rupees and the Japanese company wants to be paid in yen, well, maybe in that case, there's going to be a little bit more volatility in prices because of currency movements, and that's going to make inflation a lot more unstable as well. Her interesting response to all this is that, hey, even though we have all these changes on the supply side in the real economy, we are a bank that is focused on inflation, and we want to keep inflation expectations to be well anchored. So even if we have decreases in supply driving up inflation, we're basically still going to hike rates, and that's what she's saying in her speech. I think this makes a lot of sense. I think before Lil Brainerd went to her new job, she also gave a speech that echoed similar sentiments. So that's good news. That means that there are people in policy-making positions that are beginning to understand that maybe the world is a bit different. In line with this, though, I also like to show something that's pretty interesting that I saw on Twitter. First off, looking at the earnings for Procter & Gamble, Procter & Gamble, which reported last week, noted that their prices are going up about 10% across categories, but they're producing fewer goods, so their volumes are down. Again, if you produce fewer goods and services, but your prices go higher, that means there's less growth, but more inflation. Now, companies seem to be making up for, I guess, higher costs and lower volumes by raising prices. And it's not just unique to Procter & Gamble. There's this really great chart by Carl here, who shows that across the consumer staples, it seems to be a very common strategy for companies to basically maintain their revenue or expand the revenue by raising prices and lowering volumes. again, that's very obviously stagflationary. You're shipping and creating less stuff, but you're charging more for the stuff that you do make. There's a really good Odd Lots episode with Sam Ryans, who studies this stuff, and he also noted that companies seem to be understanding that they have more pricing power than they did before and are using that. I think politically, some people call this to be greedflation, and economically, in theory, you'd expect that if people were able to exploit their, I guess, market power to raise prices, eventually over time, there'd be more competition, competitors would enter into the market and compete those profits away. But in practice, though, that's really difficult since, I mean, it's not easy to build a big factory or build a big brand. People who are able to do that have a lot of resources. They have a big moat around their business. So in practice, the market really isn't super competitive. So you can see behavior like this, which of course makes the Fed's job more difficult as prices are going higher and inflation isn't necessarily coming down. Okay, the last thing we'll talk about is the debt ceiling. The debt ceiling is strongly related to something else that was in the market's mind a lot, and that is the 1-month Treasury bills yields basically plummeted. There seems to be a tremendous amount of demand for short-dated treasuries. And it's actually really easy to see why. So if you are an institutional investor and you have, let's say, hundreds of millions or billions of dollars to manage, you have cash, right? So you really can't leave $100 million just sitting in a bank. You could get Silicon Valley or something like that, and that's an inconvenience, and it really makes you look bad. You could put it in a money market fund, and that works as well, but a couple of downsides is that money market funds charge fees, about 50 basis points or less, could be 25 depending on the fund. And of course, money market funds, there's same-day liquidity, but it's still not completely cash-like. So what you often do if you are a corporation or a sizable institution is you would manage your cash by investing in repo, so lending to overnight on a secured basis, or you would buy treasury bills. Now, the worst thing that you want to happen is that you buy a treasury bill and then for some unanticipated reason, you can't get your money back because the treasury defaulted. So you want to avoid that at all costs. So now we know that in the coming months, there's going to be a debt ceiling episode. But what we don't know is when that happens. So if you don't know, if you have cash, you need to put it somewhere, but you're scared of a debt ceiling episode that will happen sometime later in the year. No one knows when, and it's really hard to know when. Then what you do is you just pile into short-dated treasuries like 1-month bills because you're pretty sure there's no debt ceiling episode in the coming weeks, maybe in a couple months, but not right now. Another way you can see that the debt ceiling episode is a big driver of market pricing is this chart that I'm showing here. This is a chart of Federal Home Loan discount notes and treasury bills. Now, Federal Home Loan Bank discount notes are basically bills issued by a government-sponsored enterprise. They are credit risk-free. They're implicitly backed by the government. And usually, though, they're not explicitly backed by the government like a U.S. Treasury bill, but implicitly backed. People know that pretty sure that the government will bail out the home loan banks, but they're not 100% sure. So the home loan banks discount notes will trade at a slightly higher yield than Treasury bills, which are explicitly backed by the government. That's how it normally is. Except though, when there's a debt ceiling episode. When there's a debt ceiling episode, what happens is that oddly enough, the Federal Home Loan Bank notes become more secure, more safe than Treasury bills because home loan banks don't have any debt ceiling episode. They're going to pay their investors. So investors who need safety then, who can't take any credit risk, will instead buy home loan bank discount loans rather than T-bills. And so during debt ceilings, the yields on the home loan bank discount notes trade below Treasury bills, which is what we're seeing right now. So again, this high window of uncertainty as to when a debt ceiling will occur is reflected in how the home loan bank discount notes are trading below bill yields up to half a year. So that again suggests that there is real concern in the market about when the debt ceiling will happen. Now, this is not a major thing. It's just that, so if you're a big investor, lending money to the Treasury and not getting it back when you need it is a new huge hassle. Eventually, you're going to get it back, of course, because eventually the debt ceiling will be raised. But it's a huge hassle that you don't want to deal with. And that, I think, is driving a lot of the weird pricing we see in the Treasury bill market. All right, guys, that's all we have for this week. And talk to you next week.